Hey, it's Jack. Tuesday. And today I want to talk to you a little bit about stock splits. Okay, there's a lot of myth and misconception about stock splits. Now, back in the old days, in the 80s and 90s, when there was a stock split, it was kind of big news because it was a foregone conclusion that the stock would go up after the split. Seeing as how the price being too high kept a lot of mom and pop investors out of it. So when it did split, it went up, it was more affordable. Now, one of the myths going forward here is that just because a stock splits, it becomes more affordable. It's easier for a cheaper stock to double than it is for a more expensive stock. And that is just not the case. A big stock is big because the volume is big. And a little stock is little because the volume is little. Volume is the only thing that moves the stock, not price. But it's that misconception that causes a lot of people to wait until the stock is split and then rush in and scoop up a bunch of shares. And that's really not a good strategy. Now, just backing up a little bit, when a company does a stock split, it does not change the capitalization of the company. It doesn't. It only changes the value of a share of stock. Okay, the company's still worth the same amount. It's just got more shares outstanding now that it's done that split, but the shares reflect that split. So a 10-for-1 split, the stock is going to be a tenth of the price that it was. Now, as I say, going forward, a lot of people think, well, I'll wait until that stock splits and I'll rush in and buy a bunch of that stock. And that's not the play. The play is when the stock splits, the real money is in the options because the options also split. So even though the stock is splitted, it becomes supposedly more affordable for the mom and pop investors. It's the option that has really become more affordable for the mom and pop investors. Now, they're going to rush in, buy a bunch of calls. What I like to do is use that stock that's going to split as an asset to create cash flow by selling call options, because the premiums on these call options are insanely high. And you don't have to take my word for it. Just look at the strike price and the value of a call option that expires a month out on AVGO or NVDA. Take that price you get for selling that call and divide it by the price of the stock. You'll see what your yield is for that 30-day hold or however long you're looking at that expiration. And that's much higher in these stocks than it is in a stock like Altria or AT&T. The premium on these calls on stocks that are volatile, a lot of these AI and tech stocks, it's never been this good. So when AVGO splits coming up, the play won't be in scooping up a bunch of AVGO shares after the split. It will be in using that stock to sell overpriced call options and make it a killing doing that. Stay tuned.